All right, let's move now on to our next two variables in these 12 variables that are important financial things for firms while they maximize their profit. What we're going to talk about here is marginal revenue and marginal cost. Now, these can be a little confusing, but I think they'll make sense after a while. Let's go ahead and get a definition first of marginal revenue. The additional revenue earned by a firm when it produces and sells one more unit of a product. So you remember talking about what marginal means when we did marginal utility, right? It's how much utility, how much a little more utility that you get when you consume one more unit of a product. Well, now this is on the firm's side. This is a business that has marginal, but it's not utility that's going up, it's revenue going up, okay? So when the firm produces and sells one more unit. What does that mean? That means quantity is going up by one, okay? So let's say that you have quantity is, 17, and let's say that your total revenue, when quantity is 17, let's say that your total revenue is $540, and when you produce and sell one more, if you were to go up to a quantity of 18, let me make this a little realistic if I can. Let's say that if you produced one more unit, let's say your total revenue goes up to 565, okay? Well, when you produced and sold one more unit, right? What is our change here? Our change in quantity is 1. We went up by 1 unit. Well, what did our revenue go up by? Our total revenue went up by 25. And the way you find that is you subtract the new total revenue. This is the total revenue for 18, and this is the total revenue for 17. And the total revenue for 18 is 565 minus the total revenue for 17. We went up by $25, and therefore the marginal revenue of the 18th unit is going to be $25, okay? It is the additional revenue earned by a firm when it produces and sells one more unit of a product, okay? All right, so let's go ahead and look at a formula, and then let's do a couple of examples. All right, so here's our formula. I mean, it's a formula. It's not the formula, but here's the idea. The Q represents a quantity, okay? So understand that generally speaking, every single quantity is going to have a different marginal revenue, and there's a reason for that I'll explain later, okay? So the marginal revenue for a particular quantity, let's say the marginal revenue for the 30th unit, okay? The marginal revenue for the 30th unit is going to be equal to the total revenue from the 30th unit, meaning all of the revenue. This is the added revenue. This is all of the revenue earned for units 1 through 30 minus the total revenue of Q minus 1. Well, what does Q minus 1 mean? Q minus 1 means the previous unit. Well, what's the previous unit to the 30th unit? Well, 30 minus 1 is the 29th unit. So whatever the total revenue was for selling 29 of them, if you subtract that from the total revenue for selling 30 of them, what you have left over is just the total revenue for the 30th unit. So marginal revenue, another way of saying it is the total revenue of the Qth, I know that sounds weird, Qth unit. Okay, that's what marginal revenue is. It's the total revenue for the Qth unit. How much revenue was added on to total revenue because you produced the 30th unit? That would be the marginal revenue of the 30th unit. Okay? Now, we can actually manipulate this into a formula for total revenue. Watch what I'm going to do. I'm going to add the total revenue from Q minus 1 over here, and that's going to cancel over here, leaving total revenue of the 30th unit or the Qth unit by itself. And what we come up with is total revenue. You can find the total revenue, the new total revenue for producing one more unit, if you take the total revenue from the previous unit, Q minus 1, and add to it the marginal revenue of the new unit. So let's say that total revenue for 29 units, let's say quantity is 29 and total revenue is, I don't know, $910. And let's say that for quantity 30, if I told you that the marginal revenue for the 30th unit, if I told you that the marginal revenue was $30, then to find the total revenue for 30 units, so here total revenue, we'll put 29 there. The total revenue for the 30th unit, or for producing 30 units, would just be the total revenue from producing 29 units, 910, plus the marginal revenue of the 30th unit, which would be $30. This is just a coincidence here. Then 910 plus 30 would be $940. There we go. And now what I want to do is I want to go over to our table that we're building, and I want to do the marginal revenue for the first three lines. Okay, so what we're going to do is we're going to identify the marginal revenue for these first three rows, and we are going to then after that I want to do two more rows. What I want to do is I want to use the marginal revenue here to be able to help complete some of these rows. Okay, well really what I want to do is I want to take the marginal revenue here and I want to identify the total revenue, and then we can come back to the rest of these rows in a little bit. Okay. All right, so to find the marginal revenue, first of all, we will not have a marginal revenue for this row right here. For the first quantity of 40, we cannot find the marginal revenue because we need two total revenues. We need this total revenue and we need the previous total revenue. Since we don't have the total revenue for a quantity of 39, we cannot find the marginal revenue for a quantity of 40. We have to have two consecutive total revenues in order to find a marginal revenue. So really, we're only going to be able to find this marginal revenue and this marginal revenue. So the marginal revenue of the 41st unit is going to be the total revenue of the 41st unit minus the total revenue of the 40th unit. So all we have to do to find the marginal revenue here is take this number and then subtract this number. So it's total revenue minus the previous total revenue, and what that'll give us is the change in total revenue when we increase our quantity by 1. So marginal, when we add one more quantity, our total revenue will go up by how much? Well, let's take 21, 81, and 20. Get my calculator here. 21, 81, and 20 minus 2130. Minus 2130, and that gives us 5120. So the marginal revenue of the 41st unit is 51 and 20. And now to find the marginal revenue of the second, or of the 42nd unit, we need the total revenue from 42, which is 2232.30. 2232.30, and we're going to subtract away the total revenue from the 41st unit. So as quantity increases by 1, total revenue increases by, well, let's find out. We'll subtract away 21, 81, 20. 21, 81, and 20, and I get 5110. And so marginal revenue for the 42nd unit is going to be 5110. There we go. All right, now if we move on to the fourth row here, we're given the marginal revenue. We're told that the marginal revenue of the, in fact, we're going to go here, we're going to put in 43 and 44. The marginal revenue of the 43rd unit is 51. And what that means is that total revenue is going to increase by $51 when it goes from 42 up to 43. So all we have to do is take the total revenue from 42, add the marginal revenue from 43, and that will give us the total revenue for 43. Okay, so 22, 32, 30, and then add to that the marginal revenue of the next unit, 51, and that gives us 22, 83, and 30. And so now we have our total revenue of our 43rd unit, which we can then use to calculate the price eventually. If you want to go ahead and do that, that's fine. I'm not going to do it right now. So then, actually, I may need it later, so let me go ahead and calculate the price. So in order to find the price, remember, we have to divide total revenue by quantity. Quantity is 43, so 22.8330 divided by 43 gives us a price of 53.10. So we're going to go 53.10. There we go. And now to find our total revenue for the 44th unit, we're going to take our marginal revenue of the 44th unit and add it to the total revenue of the 43rd unit. So previous total revenue plus the marginal revenue of the new unit, 50.90, so 22.83 and 30, plus the marginal revenue of $50.90 gives us 23.34.20. So 23.34 and 20, and therefore that is our total revenue for 44 units. Now to find the price, we're going to do total revenue divided by quantity. So 23.34 and 20 divided by 44 units gives us 53.05. 53 and 05, and now we have our fourth and fifth rows. We have total revenue, and we also have price, and we also have quantity. All right, so now what I've done is I've taken the first 5 rows from the table we're working on. We were able to just calculate our total revenue here, and also identify our price. And I'm only including quantity, price, total revenue, marginal revenue. I've cut everything else out. I just want to focus on a couple interesting dynamics here. The first thing I want to ask you is, do you notice that the price is decreasing as quantity increases? You may have noticed that previously when we did the first 3 rows. And I want to remind you that the reason that the price is going down is because we want to try and convince people to buy more of our stuff. So it's fine, we can sell 40 units at $53.25. But if we want to sell more, if we want to increase the quantity we sell, there are some people out there that we have to convince to come in and buy. There are people out there that won't buy for $53.25. Therefore, to get them to come in the door, we're going to start lowering our price so that we can sell more stuff. Walmart does the same thing. If they want to sell more stuff, they drop the price and then they sell a whole bunch more of it. Okay? That's why the price is decreasing as the quantity is increasing. Now, we're going to talk about this later also. When we start talking about the market forces of supply and demand, this idea is going to come into play again. Now let's go over to marginal revenue. Did you notice what is happening to marginal revenue as the quantity increases? I hope you thought of something that we've already learned about when you saw this. Now, revenue is the benefit of a business. The benefit that a business is gaining from doing business is called its revenue, right? And this is marginal revenue. So what we could say is that marginal revenue is the marginal benefit of a business. Now, do you remember the law of diminishing marginal benefit? Well, for a business, we could call it the law of diminishing marginal revenue. And what is happening as our quantity produced increases? As we continue seeking more benefit, as we use up more resources to produce more stuff, what's happening to the marginal benefit that this business is earning? Well, it's diminishing. It's getting smaller. And so what you can see here is the reason that marginal revenue decreases as quantity increases is because of the law of diminishing marginal benefit. Now, why is that happening? Mathematically, the reason that the marginal revenue is decreasing is because the price is decreasing. And the reason the price is decreasing is because we can't get people to come in and buy more stuff unless we lower our price. And so you can see in here that the law of diminishing marginal benefit is loaded right into the problem of scarcity faced by a business. Okay? And so the last thing I want to say here about marginal revenue before we go into marginal cost is, remember our saying is that benefits tend to decrease as we use more resources, right? Well, here you go. Benefits tend to decrease as we use more resources to produce higher quantities, okay? Now let's go take a look at marginal cost. All right, now let's talk about marginal cost. If you understood marginal revenue, marginal cost is going to be a breeze. It's the exact same thing, only related to total cost, whereas marginal revenue was related to total revenue, okay? Marginal cost is the additional cost incurred by a firm when it produces and sells one more unit of a product. So here's our formula. We're going to say that the marginal cost at quantity Q is going to be equal to the total cost for quantity Q minus the total cost at quantity Q minus 1. Okay? So basically, here's the idea. Let's say that at a quantity of 23 units, let's say that the total cost for the firm is equal to, I don't know, let's say $4,500. But if they produce one more unit, if they go up to a quantity of 24, now their total cost is going to be $4,650. So if you want to know the marginal cost of the 24th unit, all you have to do is take the total cost from the 24th unit and subtract away the total cost from the 23rd unit. And $4,650 minus $4,500 is $150. Therefore, the marginal cost of the 24th unit is equal to $150. It is the increase, it is the added money onto total cost. It is the increase in total cost as you go from one quantity up to one quantity higher, Q plus 1, okay? Now, also, if this is our formula for marginal cost, if this is how we can determine marginal cost by simply subtracting the new total cost minus the old total cost, we can also manipulate this algebraically to try and figure out how to find the total cost if we don't already know it. If we know the marginal cost of the business for that unit, and we know the previous total cost, algebraically all we have to do is add total cost of the previous unit to both sides, and that'll give us the new total cost. So the total cost for any quantity in a business is equal to the previous total cost at Q minus 1 plus the marginal cost of the new unit. The marginal cost of the new unit. So let's say that Q is the 117th unit. That means Q minus 1 is the 116th unit. We can take the total cost for producing 116, add to it the marginal cost of the 117th unit, and that will give us the total cost for producing 117 units. All right, let's go over to our table now and use the calculate marginal cost, and also use marginal cost to find the total cost. Okay, so what we want to do here is we want to identify the marginal cost for these two rows. Just like with marginal revenue, we can't find the marginal cost for a quantity of 40 because we would need the total cost from 39, which we don't have. Therefore, we're going to start with finding the marginal cost for 41. Marginal cost is the increase in total cost from the previous quantity to the new quantity. So what we need here is we just need to find out how much did total cost go up by from here to here. Well, that's easy. We just take the total cost from 41 units and subtract away the total cost from 40 units. So 1900 minus 1850, that's an easy one. That's $50. So marginal cost, the marginal cost of the 41st unit is $50. What that means is that to go from 40 units up to 41 units, total cost has to increase by $50, which it did. Now, to find the marginal cost of the 42nd unit, we need to take the total cost of the 42nd unit and subtract away the total cost of the 41st unit. So we're going to take this 1950 and 20 minus 1900, another really easy one. So this number minus this number gives us $50.20. All right, now we have the marginal cost of the 43rd unit and we have the marginal cost of the 44th unit, but what we don't have is the total cost of the 43rd and 44th. So to find the total cost of 43, we're going to take the total cost of 42 and add to it the marginal cost of 43. So total cost of 42 is 1950 and 20. So I'm going to type that in, 1950 and 20, and I'm going to add to that the marginal cost of this unit. So we're adding on $50.40, and that gives us $2,000.60. So $2,060. And now to find the total cost of the 44th unit, we're going to take the total cost from the 43rd unit and add to it the marginal cost of the 44th unit. So the marginal cost, as we go up by one quantity, we're adding $50.60 to the previous total cost. So we'll take $2,000 and then 60 cents and add to it 50 and 60, $50.60, and that gives us $2,051.20. And that gives us the total cost. Now that we have total cost for 43 and 44, and we also have total revenue from 43 and 44, now we can find profit from 43 and 44. So profit is total revenue minus total cost, so $22.83 and 30 cents minus total cost, which is $2,060, leaves us $282.70. So $282.70 is the profit for 43, and now the profit for 44 is going to be total revenue, $23.34 and 20 cents, minus total cost, which is $20.51 and 20 cents, and that gives us $283. So $283 is the profit for producing and selling 44 units. Now we need the variable cost and the fixed cost. Well, fixed cost is easy. Remember, fixed cost is 500 all the way down. So we'll go 500 here, 500 here. And now, to find variable cost, we just have to subtract fixed cost from total cost. So $2,000.60 minus $500, that is $1,500.60. So now to find the variable cost for 44 units, we just need to subtract fixed cost from total cost. $2,051.20 minus 500 is that's $1,551.20. And so now we have the first 5 rows for the first 9 variables complete. All right, so what I've done here is I've brought over the first 5 rows again, only this time we're focusing on the costs of this particular firm. Now, we just saw how we can use total cost to calculate marginal cost, and we also saw how we can use marginal cost to calculate total cost, as long as we have some previous information, right? So here's the idea. I wanted to just point out a couple things, 2 things here that I want you to notice, okay? The first one is, do you notice as quantity increases, what is happening to marginal cost? It's increasing as quantity increases. And that's because of the law of increasing opportunity costs. Remember what we said? We said that costs tend to increase as you seek higher benefits. So, are seeking higher benefits, look at this, it's going up, we're seeking more benefit. We know that if we produce more, that we could sell more. Selling more would give us more revenue, so we're seeking more benefit. Well, as we seek more benefit, as our pursuit of benefit increases here, our costs for each one are going higher, 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 higher. If I want to produce, instead of 43, I want to produce 44, the added cost goes up by another 20 cents, which is then going to cause my total cost to not just increase. It will increase if I just add a number on. It's increasing in bigger and bigger and bigger jumps. First, it increases by 50. Then it increases by 50-20. Then it increases by 50-40. Then it increases by 50-60. What I am adding on to my total cost is getting larger, 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 larger. And so I want to point out that our added revenue is getting smaller, our added cost is getting larger. And what eventually is going to happen is this. Our marginal revenue is getting smaller, our marginal cost is getting larger, and what's eventually going to happen is these two are going to cross over each other. Currently, this is larger and this is smaller. But this is larger getting smaller, so it's becoming a smaller number. This is smaller becoming a larger number, so eventually what's going to happen is this is going to become larger than this, and this is going to become smaller than this. And that's a very important thing in microeconomics. The second thing that I wanted to point out here is this. I want you to notice, let's remember that fixed cost is not changing at all. So total cost is increasing. Why is total cost increasing? Because we're producing more. And producing, when we change our quantity, doesn't that change our variable cost? So our variable cost is going up. Fixed cost not changing at all. Therefore, total cost is increasing by the exact same amount that variable cost is increasing by. You see here, total cost went from $18.50 up to $1900. Total cost increased by $50. Well, so did variable cost. It went from $13.50 up to $1400. And when total cost went from $1900 up to $1950.20, variable cost went from $1400 up to $1450.20. They went up by the same amount, $50.20. And here's what I want to point out, is that you can find marginal cost not only from total cost, you can also find marginal cost from variable cost. And you can find variable cost if you already know the marginal cost. These two, variable cost and total cost, are going up by the same amount. So I'm going to give you one more formula. We can also say that the marginal cost of the Q unit is equal to the variable cost of the Q unit minus the variable cost of the Q minus 1 unit. It's the exact same formula as if we had total cost. Change the T to a V, it's the same formula. So all I want you to understand is that you can find marginal cost using just variable cost if you don't have total cost.